We're here to talk about Silicon Valley real estate market. This is a couple of the slides that we're going to be going over. These are the different chapters you can jump to. And here's the first set of data slides. What we're looking at here is marketing time. How many days does it take 3/4 of the sellers to sell? We go back a whole year. We start off jumping back 4 or 5 weeks, trying to emulate a month. And then 13 weeks ago, 3 months back, we jumped to weekly data. The concept is to just see how the market changes over a year, because I believe there's a strong annual cycle in the local real estate market, and also just how it's been changing the last 13 weeks, last quarter. What you have here is the dashed purple line, which is the current data. And so you can see that it's a little bit below a couple of these solid lines. That actually suggests that marketing time has improved recently for a lot of the sellers, but we're also significantly higher than the blue dashed line down here, which is where we were a year ago. So the market is cooler than it was a year ago, slightly better than it was just the last couple weeks. And we'll step in, and we're starting from the blue line, and each slide is starting off at a month. So you can see a big jump there. And that's the worst month, 8 months ago, which would have been January 17th, basically the beginning of the year. We're approaching the best month ever right there, April 19th of 2024. Then you had a month at that fast level. And now you can see the slowdown that we've been going down through. And when we go from dashed lines to solid lines, that's when you got the most recent. So right here are the most recent weeks. And you can see the improvements, some bounce. And so that green line was just last week. So there's an improvement from last week to this week. So again, last week is up there. This week is down there. So you can see a little bit of a shift. Those little shifts really are not that significant. It's basically a plateau. The big things to take away is initially from this time of the year to the end of the year, the market really slows down. This particular slide showed the coolest being right around January the 17th, and that's basically when the market catches on fire and heats up and starts eating through all the old inventory, and therefore weeks after that have some of the lowest days on marketplace. And that's when it would improve dramatically down to here. That was around April the 19th. And then we basically had a couple months, like maybe 2 months up at that at that level. And then we cool down, and we've been at the current level for some period of time. Now, doing the same type of thing with price reductions. This is the seller's price reduction. So this is a measure between where the seller's expectations are and the market reality is. And again, you can see a year ago, you're on this blue line. Current is here. So the current is on a cooler side of a year ago. So the market is definitely cooler. Sellers are taking larger price reductions. There's two parts of price reductions. Are sellers taking larger price reductions, or are more sellers taking price reductions, or is a little bit of both? And we'll take a look into that, but let's go through this first. You can see with the slide there, it's cooling down. There's the bottom. And again, that was around November 22nd, but there was a little bit of a plateau. Now you're at the peak right there again, April 19th. And then you can see you've really slowed down pretty quickly. Then you got that summer plateau. And then you sort of bounce around a little bit, which is sort of the summer plateau. And we're basically in the fall plateau at this point. And again, you can see that week is worse than the current week. So again, there's been a slight improvement in the last week on how many sellers are taking price reductions, which means fewer sellers are taking price reductions, or they're taking slightly smaller price reductions. Then we flip over and we look at what the buyers are doing, and the concept is the same. In this particular case, the purple line is very close to the year ago blue line, but it is still on the cool side. So all three indicators indicate the market's a little cooler this year than it was last year. Stepping through, you can see that there was initial improvement, and then the slowdown. There's the bottom again, January 17th. Now you're jumping up. That's basically the peak, which again was April the 19th, and also May 24th was up there. Then you can see the slowdown. And now we're into weekly data. So each one of these lines is a week. So there's a little bit more movement maybe than the graph would indicate. And again, there's those 2-3 weeks are worse, cooler than the current week. But that was several weeks ago. Last week looks like about the same. One of the things you have to remember on overbidding is there's a lag. And what's really interesting is I've noticed that the amount of lag time, it's the length of the typical escrow, but that typical escrow at the peak of the marketplace, the buyers that are being the most aggressive on their overbid are also being aggressive on their short closes of escrow. So that shortens to about 3 weeks. Normally it's closer to 4 or 5 or 6 weeks. So it's just interesting. You can't even predict what the lag time is without more information, but the lag time is significant. And that's because you need to get the sold price, which is not until after the escrow closes. Now we're moving on to 20 micro markets. The concept here is you break up the 3 counties. Santa Clara County is areas 11 through 17. San Mateo County is areas 21 through 26. And then Alameda County is areas 31 through 37. My index is down here being 42 through 44. Here, if you have a shortage of inventory, that favors the seller because there's less competition and less for the buyers to pick from. The normal marketplace is basically 12.5% on each side of 100%. I use that range quite a bit. It's sort of arbitrary, but it also seems to work. And then a cool marketplace is anything more than 12.5% surplus of inventory. So you can see that most of the areas, according to the map, are normal, and that means they're within 12.5% of 100%. And you can see there's some areas like Los Altos and Palo Alto at 102%, South County at 101%. But most of the areas, like all of Alameda County, is at 97%. And that's because I don't have it broken down in the micro market areas. But San Mateo is basically right around 95%. Santa Clara County is a little more spread out, but maybe somewhere right around 84% or something like that, maybe 85%. It's hard to guess. You got 91 and 92 and 94 at 71, and that's the only hot area. The next hottest is Saratoga Los Gatos at 85.2. I think those are the only areas. Bay City's at 86.4. So you have 3 areas that are slightly less inventory than the 12.5% benchmark to get a slight pink color. Doing the same thing with the offers in the same 12.5%, you can see the offers being blue are a little more widespread. So now that's basically saying there's a lack of offers, and the lack of offers is greater than the lack of inventory. And you can see the areas that have the biggest lack of offers. And right now, I think it's going to be Redwood Cities, which is actually a little surprising. They only have, they're missing a full third of the marketplace. They only have 2/3 of the market that they typically have for this time of the year. Everything's compared to the same time of the year because there is such a cyclic marketplace. Then you look at DUI, and because Redwood City had the least number of offers and had reasonable inventory, it's got the second slowest days of unsold inventory. And this is days of unsold inventory, the speed of the market relative to where it normally is. It's a third slower than it normally is. Atherton, Menlo Park, and Portola Valley, Woodside, sort of the expensive areas in San Mateo County, is 43% slower than it typically is. Everything else is sort of in balance. Alameda County comes in at 103%. Santa Clara County is coming in roughly at about almost at 100%. You got several areas up here at or above 100%. And then you have several areas that are basically at 90 to 97% of where they expect to be. Santa Clara County and Alameda County are basically essentially as fast as you'd expect the market to be for this time of the year. San Mateo County, on the other hand, is a little different. And it is interesting, the San Mateo County coast is actually a little faster than it is now. And that's interesting because just a few weeks ago, that was a real slow area. Now moving on to days unsold inventory now. This is ignoring compared to where it normally is and just looking at where it is. And although it on the previous slide, it was basically normal, here you're basically, for the most part, in a red marketplace, which is favoring the sellers. And when you look at this, Santa Clara County is basically 25 days. Maybe if you average in some of those 40s, maybe it's 30 days. But what that's saying is, although 30 days of unsold inventory is a fast marketplace, the cutoff is basically 42. That is typically slower than where it normally is. So Silicon Valley is basically, or about where it normally is. So Silicon Valley is normally a fast-paced marketplace. It's just there's a shortage of housing for the demand, but the demand now exceeds the number of houses. The only area where it's slower is the expensive areas in San Mateo County at 141 days. So that's actually a very slow marketplace. I go solid blue at 145. So that's almost as a deep a blue as you'll see. Oakland's at 96 days. After that, you jump all the way down to 60 days in San Leandro, Hayward, and also in South County. So you basically are from 60 days down to a low of about 24 days. So you go from 24 to 60 days, except for the two slow areas being the expensive areas in San Mateo County at 41 days and Oakland being at just 97 days. Now, this slide is here for the people that don't like statisticians like myself that play around with the numbers. So it's simply, how long is it taking 3 out of 4 sellers to get an offer on their property? And the shorter the time frame, the faster the marketplace. So you can see that most of Santa Clara County is from 15 to 40 days. San Mateo County is basically from actually a little bit better than that, 13 days to 60 days. And Alameda County, which I do have the individual micro market data for, is basically from 20 to 60 days. So you got a little bit of a range. It changes quite a bit depending on the area. You can see the expensive areas in San Mateo County coast. And somewhere, I think it should be right here, sort of a blue tint for showing Oakland. So Oakland should be right here by the airport. And this one up here is Alameda Island. I do it by zip codes, and I'm not that positive on all my zip codes that far north, but I think Oakland is going to be down here. It's a little misplaced. It's actually, it's probably right here on the inside. So that would be part of Oakland. Here's your ask price adjustment. So this is how much of the sellers are doing price reductions. And this is the average. So this is putting all the sellers in a blender and saying, what are they doing with their prices? And since it's so unusual right now, I'll point out that Milpitas, North Valley, Berryessa, Paso Valley, and Santa Teresa are actually raising their price 0.3%. Now, in all fairness, there's a reasonable chance that I missed data entry error where someone listed a property at 90,000 instead of 900,000. So now it's showing that the seller raised their ask price 810,000. And when you average that in, it happens. So when you have one area outlying like this, it's a question mark, and it's a red flag that had I noticed beforehand, I would have looked into it more. I just have limited amount of time. Since this data is as of midnight last night, it takes time to gather, process, and present the data. That's why it normally is not 100%, but it's pretty darn close. And when you see something like this, it stands out, so you know that it's questionable. And you can go back and look at like what was last week is, and you can look at what next week is. But basically, price adjustments here are fairly tight metric, and that's because the vast majority of the sellers take no price adjustment at all. And we'll get into that next. Basically, from anywhere from a 0.25% to 1% price reduction is what I consider white. More than 1% it starts becoming significant. Less than 0.25% to a positive increase of any amount is, favoring the seller. So most of these areas are favoring the buyer, and the sellers are taking a 1.5%, it looks like, to 2% price reduction in most of those areas. The most expensive reduction I'm seeing right now is the expensive areas at 3%. The San Mateo County coast is at 2.5%. If I remember correctly, that was at 4% and 5% not that many weeks ago. So that's actually a fairly significant improvement. Here's the frequency of seller price reductions. And what you can see is these numbers are fairly small. But if you have less than 17% of the sellers doing price reductions, so less than 1 in 6, that's a hot marketplace. From 1 in 6 to 1 in 5 is a balanced marketplace, and 1 in 5 to 1 in 3 is a buyer's marketplace. 2/3 of the sellers aren't ever going to do a price reduction, at least roughly. And the reason for that is sellers do their homework along with their listing agent before they put their house on the marketplace. Being on the market isn't fun. Keeping that house clean, ready to show. It's not uncommon for the sellers to do their homework well and price their home to sell it. And that's why, even though the market may be slow, the numbers of sellers that are doing price reductions is pretty low. And you can see the Mountain View, Cupertino, Sunnyvale area here has some of the lowest at 4.8%. So that's less than 5% of the sellers are doing a price reduction. And then the blue areas are going to be the highest, and it looks like maybe Pleasanton is the highest, where 34% of the sellers are doing price reductions. Anywhere from 1 in 20 sellers doing a price reduction to 1 in 3. So you can see it's a fairly wide range, but you'd almost expect half the sellers or 2/3 of the sellers to do a price reduction. Why not start off high? And that's just not the way the market operates. Now we're flipping over and looking at the buyers. And we're going to do the same thing. We're going to look at the magnitude of overbidding first. Here is the average overbid. So this is putting everybody in and then just looking at the average. So South County starts off at 0% overbid. The highest in Santa Clara County looks like 8.7% in Cupertino. You go down to San Mateo County, and the most aggressive overbidding is a negative 1.8, almost 2%. So the coast is taking a 2% price reduction. And the biggest increase is the north part of San Mateo County, which is like Daly City, Coleman, areas like that, at a 9% overbid. And then you go into Alameda County and you go, Berkeley is on the high side at 14% above, and the low is Pleasanton at 0.2% above. Alameda County is completely overbidding everywhere, and Pleasanton would be white in color, and that makes sense. Basically, here your price range is 1% below and 1.5% above is a balanced marketplace. Now you're looking at the frequency of overbidding. So how common is overbidding? In Santa Clara County, you're probably right around 60 to 70%. San Mateo County, it looks like you're from basically 50% to 75%. And in Alameda County, you're basically from 45% up to 73%. Very aggressive overbidding. So the magnitudes are coming down, the frequencies aren't. And that is typically what I see. The buyers are still willing to overbid, a token amount to maybe stand out, but the amount that they're overbidding has come down. Here's the appreciation now, and this is going back to the last 9 months, the last 3 quarters of 2015. I was trying to find a full year of where prices were level, because you don't want rapid price changes to get a good benchmark. And you can see it's sort of the outlying, more affordable areas that have done better. And I believe this is directly related to the pandemic. And earlier, it was like the Livermore, Pleasanton, the really outlying areas that were doing the best. And I think what's happening now is we basically had the pandemic, and that took away the premium from areas that are close into the workplace. Then when people were able to work remotely, the far away areas became very desirable. And now that a lot of places are requiring 2 and 3 and working up to 4 or 5 times back to work, people are coming back into sort of the mid-range, which is within Santa Clara County and Alameda County, and that's where the most appreciation is. And because of compounding, whatever areas has the highest recent appreciation usually has the highest overall appreciation. And you can see you could have areas like the San Mateo County coast where they've only gone up 30, 40%, 38 or 40% since 2015. You have other areas that are approaching and exceeding 100% in Alameda County at 100.5% and 105.6 or 106% in Fremont. So Fremont's got the highest appreciation at the moment. Here's your sold price, and instead of following the median, which is the middle number, as most statisticians do, I sandwich it and I give you the cheapest 10% on the left-hand side and the most expensive 10% on the right-hand side. In South County, you basically go from $1 million to $2 million is your price range, with the middle being $1.25 million. And you can go down and do that for any areas. Here, the red is simply what areas are the most expensive. The pink and white colors, and it's really the whites of Fremont and Campbell, are sort of the median price for Silicon Valley, and that would be about $1.9 million for the typical median priced home in the median priced areas. And then your outlying areas are here in Santa Clara County or in Alameda County are the darker blues, and they're typically the more least desirable areas or the ones with the longest commutes. They're the ones that tend to be the more affordable. And here's a summary of what we've gone over. The first 2 are basically don't really tell you where the market's doing by themselves. It's sort of the ratio of the first 2 that tell you, which is the second column. And the reason it's a lighter shade of yellow on the highlight on the top is it's really not a market indicator. DUI now is DUI versus the 10-year is sort of just a loose indicator. I probably should make this a dark yellow now that I'm thinking about it. And these are the 2 that are, and I'll actually say these are the 3 that are really the key indicators of where the market conditions are. Days on market, nobody really has control over that. The listing agent might hold it on for 7 or 10 days, but 3/4 of the sellers is a number that moves back and forth. Maybe 3/4 of the sellers are within the time frame that the listing agent's holding the property on the market. Maybe it's not. When you look at these numbers at 16 and 60 days and things like that, that's longer. Typically, agents hold the market on from something like 5 to 10 to 12 days. So all these are usually past where the listing agent's holding it on the marketplace. seller ask price adjustments. Clearly, that's something that people aren't planning on doing. And the reason I do the frequency in the lighter shade is this tends to lag behind adjustments. So I'd look at the magnitude of the adjustments before I'd look at the frequency. Same thing with the overbidding. The magnitude is more important than the frequency. So the magnitude is coming down. You can see that the frequency is darker red overall. Then you have appreciation where it's really not favoring the buyers or the sellers, but it indicates where the buyers have done the least well, because this is favoring the sellers. The sellers have done the best in the dark areas and they've done the least in the blue areas. So basically your San Mateo area, as you notice, I've sort of put in blue horizontal lines showing Santa Clara on the top, San Mateo in the middle, and Alameda on the bottom. And then you move on to your price, and I've added in the payment. And the payment assumes an 80% loan and assumes the federal fixed rate for a 30-year fixed mortgage. Here's a quick summary of the slides. This is going back 14 weeks. So this is basically a quarter with both ends on there. And I've lined up the data points horizontally. So this is current week, back 1 week, back 2 weeks, and then back 14 weeks. The blue thin line is the coolest level you'd expect the metric to be. The gray line is where you'd expect the metric to be in a typical marketplace. And the red is the hottest you'd expect it to be. So your inventory was at 2560, call it, and that was 92% of where it typically is. We've now grown to 2660, so we've picked up basically 101 new active listings, but the inventory has actually dropped to 90% from 92%. So you've had a drop of 2% of the inventory, and that's why the gap here from the gray line is a little bit bigger than it is over here, is that 2% you can actually see in the graph, which is a little surprising, and it's a little bit closer to the hot marketplace. So that's, less inventory is a hotter marketplace. So you have 2% less inventory than you typically do, even though that represents a growth of 100 in the inventory. So now we're moving on to offers, and you can really see the offers have hugged the bottom here and basically been the least you'd expect. And then actually for several weeks, we were below the least you'd expect, and we're basically approaching back up to the least you'd expect. And again, it's the percent away from the gray line. This distance is bigger than this distance, and so this is a bigger drop. Here your drop is 73%, so it's a drop of 23%. Here your drop is only a drop of 17%. So you've gone from a fairly significant shortage, and even 83% is short, but you've gone from a shortage of, what did I say, that was 23% to a shortage of 17%. Meanwhile, the number of offers had dropped 100. So you've lost 100 in your offers, but you've improved. That drop of 100 in offers is less than it typically is. So you've actually gained market share. You've gained from that 23% up to the 17. So you gained 6%, 7% of your market, even though the number of offers have dropped by 116. Now, the speed of the market is measured by days unsold inventory. You can see you went from 40 to 43. So you've slowed down 3 days, and your speed of the market is you've gone from 120% of the market, which is 20% slower than it typically is, which is why you're quite a bit above the gray line, to now 99%. So you can see the purple line is essentially right on top of the gray line, but knowing that's 99, it's actually a little bit below the gray line. Big improvement, much slower than you'd expect here. About midway through the quarter, so about 7 weeks ago, you started tracing right on the grain line. Then you had a slowdown 1 week ago and 2 weeks ago, and now you've come out and you've improved, and you're back to where exactly where you'd expect the market to be. You're not going to get any closer than that. You're going to rarely be at exactly 100%. Moving on to the days on market, the time to sell, you went from 91% to 102%. So a slowing down of the marketplace. But look at this, you've gone from 15 to 25 days. You've almost doubled the time on the marketplace, and your gray line has gone from a little bit below, so that's the 91%, to a little bit above, and you can see you're basically right on top of it. You are on the high side of the gray line. So the market is now performing exactly where it was. Fairly good chance, just based on how the data here is, that this could have been performing normally prior to the 14 weeks that I go back. I don't have that data exactly here on the slide, so I can't tell you for sure. But basically, it's been following the normal progression. There was a little bit slower marketplace for the last 1 to 4 weeks ago, was a little bit slower than it typically is. Right now, it's right where it's been for the most time. It's been right where it is. Moving on to price reductions, we've gone from 0.7% price reduction to 1% price reductions. So that's a 0.3% increase in the amount of price reductions. But basically, on a percentage of normal, you're at 120%. Here, you're 122%. So you're basically performing normally. And you can see you're basically tracing that gray line, but a little bit on the low side of it. Moving on to overbidding. The overbid 14 weeks ago was 8.4%, which is 1.5% more than normal. So the normal amount of overbidding would be 7%. You're at 8.5%. Normal bidding over here would have been 4.7%, and now you're at 5.8%. So again, you can see you're above the gray line, so you're hotter overbidding. Here's going back to 10 years. So here's 2014 to 2023, sort of on what I call a condensed scale. And then you move over to a more expanded scale so you can see the trends better. You have a full year, which is 2023, and then the current partial year. You're looking at percent of inventory. So inventory is 90% of where it normally is. Offers accepted is down here at about 84%. And that gives you a days unsold inventory exactly normal. Now, the reason this is exactly normal instead of below normal is because these three indicators are in different years. And the last time I looked at it, offers and inventory were in the same year, and the median days of unsold inventory was a different year. And that's why this number is at 100% instead of being a number that you would expect it to be something lower than 100%. Here is the same concept where you go back 10 years. Now I've added in the blue line, which is the coolest marketplace you'd expect. The gray line is where you'd expect the market to be. And the red line is the hottest you'd expect the market to be. So you can see we were on the red line for the last year and a quarter. And then for the last 2 quarters, for the last 6 months, we've had less inventory than normal, but much closer levels of normal inventory. And what you expect the data to do, you expect this data to start falling off this cliff, because that's what it typically does. Here is taking that gray line and stretching it out, so you can see that you have only 90% of the inventory that you typically do. Moving on to offers. Offers were quite a bit below the blue line, so you have quite a little bit less offers than you expect. We got a fairly significant bounce the last 2 weeks, it looks like, 1 week to there, and then a second week up to here. And we're finally approaching the least offers you'd expect. So it's the lack of buyers that is the key, but there's been a significant improvement in the last 2 weeks. Here you're pulling out the line. You can see that you got the lack of offers. Just 2 weeks ago, we were basically at 74% of the offers you'd expect, and now you're at 84%. So you've picked up 10% of the typical marketplace in just 2 weeks. Here's your days unsold inventory, and it's basically following, it was above the gray line. The improvement, because of the increased number of offers, brought it back down to the gray line. We don't know if we're going to stay on the gray line or if we'll bounce above or below next week, but the market has definitely improved the last couple of weeks. And this is showing a huge slowdown in days unsold inventory. And based on this slide here, there should be a huge improvement. I suspect I am missing the most recent data point here, and I expect it to come right down, and I expect it to be at 100%. So I think that's missing a data point on this graph for some reason. Here's looking at marketing time. You can see the improvement in marketing time, where we've gone from basically, well, the number of improvement isn't there, but we can see the turn back to the gray line. You can see the turn back to the gray line on this chart, which is what I would have expected. Here's looking at the largest sellers that are taking the biggest price reductions, and that's why these numbers are so big. So the sellers that are taking, the 10% of the sellers that are taking the biggest price reductions are taking a 13% price reduction. And that's what this basically saying. Typically, they're taking about a 10.5% price reduction. So they're taking a bigger price reduction than they normally do. And that favors the buyer, which is why the purple line is on the blue side of the gray line. Here you can see that it's on the blue side of the gray line. And I don't have the gray line at 100%, because even in a hot marketplace, there are some sellers that want to test the marketplace. So there's usually some sort of price reduction. And that's why I consider from a 0.5% price increase to a 0.25% price decrease to be normal. Here's looking at the average. So this is the numbers that we were presenting before, and I'm doing it for inclusion. Basically, right now, the average price reduction is 1%. You can see it's below the gray line on the cool side. So sellers are taking larger price reductions than typical. Here you can see they're taking larger price reductions than typical. Here's the frequency of price reductions. So the frequency is exactly normal. So now we have the answer to the question I proposed earlier, which is it's not more sellers taking price reductions. It's the sellers that are doing price adjustments are taking larger price adjustments to get their property sold. Here's compared to normal. So you can see we've been bouncing on both sides of normal for some time now. Here's the median overbidding. So we're going over, and this does appear to be median, and that's why this number is at 3.5% instead of a number we were seeing earlier around 5, which was the average, or I guess it was closer to 6 or 7%. So this is median, and that's how it's labeled up here. This is the midpoint. Half the buyers go in more than 3.5%. So more than half the sellers go in over 3.5% over ask price, and half go in less than 3.5% over ask price. Here you can see that's greater increase than normal, more aggressive overbidding than normal. Here's the frequency of overbidding. So again, the frequency of overbidding is a little bit above normal, but pretty close to normal. I would call that normal in my book. It's, slightly above the gray line. So you're slightly above the gray line. Here's notice the turnaround last week. We had been doing this downturn, which is earlier than we normally do. Normally you have a V at the end of the year, and now you've turned around and gone up. Are we going to buck and not go normal trends and come back down? That's the thing about, you can always make a suggestion that it should go somewhat up along this line, but you never know what it's going to do. This decrease was sort of more than I would have expected, and I've also wouldn't have expected this turnaround and an increase. Here's your payment. So the cheapest 10% home is to have payments around $6,200 a month. Your median priced home has a payments of around $11,700 maybe, and your most expensive 10% home has a payment around $23,500, all assuming 80% loan. Now we're moving on to the individual components of the 3 counties. So we're going to look at Santa Clara County in the blue, San Mateo County in the orange, Alameda County in the gray. So Santa Clara has less inventory than Alameda, where normally historically it's the same. Offers accepted. Santa Clara is outbeating Alameda County, so I'd expect Santa Clara County to have the lowest, fastest DUI, and here it is. Santa Clara County has the fastest DUI, followed by San Mateo County, and Alameda County has the slowest, and that's going to be interesting in a slide here. Again, Alameda County has the longest marketing time. San Mateo County is sandwiched in the middle. Santa Clara has the fastest marketing time at 22 days. Now look at the price range, and this is the magnitude of seller price reductions. Alameda County is doing the least amount of price reductions, although it has the longest marketing time. Santa Clara is in the middle, taking the second most price reductions, even though it had the fastest marketing time. And San Mateo County, that had the middle marketing time, is taking the largest price reductions. Moving on to the frequency of price reductions. Here it makes a little bit more sense. Alameda County has the most price reductions, the most frequent price reductions, and they have the longest marketing times. San Mateo County has the second most frequent price reductions with the second longest marketing times, and Santa Clara County has the fastest marketing times with the least amount of frequent price reductions. Here's flipping over now and looking what the buyers are doing. In Alameda County, even though they have the longest marketing times, buyers are overbidding the largest amount. That on the surface doesn't make sense. The only thing that would tend to make a little sense, they also had some of the largest price reductions, if I remember correctly, from a few slides ago. So they may be reducing their price and then getting the overbids. San Mateo County in the orange is in between, which would make sense. And Santa Clara County, that had the fastest marketing time, has the least amount of overbidding, and that also doesn't make sense. The frequency of overbidding. So how common is overbidding? The least frequent is Santa Clara County. So again, Santa Clara County, that has the fastest marketing time, has the least frequent overbidding, which on the surface really doesn't make sense. The only way I can sort of try to justify it, and I don't know how I can measure this, is if the marketing time is the fastest and they're just about to do price reductions so the buyers don't have to overbid, where in Alameda County, the marketing time is longer, so the sellers actually did price reductions. So buyers then come in and then overbid by a larger dollar amount. I guess what I'd have to do is track each property for the days on market at the current ask price, and that would be a Herculean task. So I'm not going to even try. San Mateo County and Alameda County are essentially tied for the frequency of overbidding, and that frequency would be about 66% of the sellers. So about 2/3 of the sellers are getting overbids, where in Santa Clara County it's 64%. So not that much of a difference. Looking at appreciation, Santa Clara was by far got the highest appreciation at 95% appreciation, almost a doubling of their money. San Mateo County is actually pulled out this last week and higher than Alameda County, but they're essentially tied at something like 70% appreciation. I would say that San Mateo County is probably 70.25%, and Alameda County is probably at 70.1%. So not much of a difference. Here's your sold price, and note the significant increase in price in both San Mateo County, the largest increase, and Santa Clara County. And now it basically has them back to just above their 2023 pricing in both Santa Clara County, blue to blue, and in San Mateo County, orange to orange, and also going right through the peak pricing in 2022. So very similar. Alameda County is very closely related, but I would say the increase in Alameda County was less significant this last week, and therefore, instead of being slightly above their 2023 pricing, it's right through the middle of their 2023 pricing. Here's the same information on regular paper for those that prefer. The previous was on logarithmic paper. Here's the estimated payments, and they're going to be in the same order as the price. The increase in price outweighed the decrease in interest rates, so payments actually went up in both Santa Clara and San Mateo County. It went down in Alameda County. Here is the chart that I have up here, mostly for the last line showing the lack of offers, but we're actually not doing that bad. We're still the third worst year at 23 out of the last 25, and the second worst year out of the last 10. The worst year in the last 10 is 2018. The last worst year out of the last 25 was 2007 at 1480. Currently, we're at 2102. We're 15% above our worst year, which was last year in the last 10 years. Here's the actual numbers, whether you want Silicon Valley as a whole, Santa Clara County as its own, San Mateo and Alameda counties, and then your different metrics coming down the left-hand side here. You can look at whatever number you want and whatever you find most significant. Here you can see that I have both the median and the average overbidding, and you can see what the difference is. So we've been talking about Silicon Valley market analytics for September 21st. We will be going on to the Greater Bay Area. The blue URL up here is my YouTube archive. And if you want to type less, you can type in the green root URL here. It will take you to the same channel. To get to the presentation live Saturday morning at 9 a.m., add in the green root URL plus 2024 for the year. For the handout, which is posted, you add in the green root URL plus the letter H for handout, 2024-09-21, which is essentially the year, month, date code. And any specific episode, if you just want one episode, you can type in the green root URL plus the year, month, and day you want. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers here in Silicon Valley. Happy to discuss the marketplace in general, any questions you have about the buyer representation agreement, or work with you in finding a property. You can reach out to me in any way you feel comfortable with, phone, text, or email. I would appreciate it if you like each video and subscribe once. Moving on to the Greater Bay Area, we have been covering the first region of Silicon Valley in depth. We will move on and add in San Francisco and Marin, which I often refer to as the cities. Then the North Bay, which is Sonoma, Napa, Solano, and Contra Costa. San Joaquin and Sacramento is the Central Valley, and the Central Coast is made up of Santa Cruz and Monterey. Here is the inventory, and you can see that the inventory for North Bay and the Central Valley has come down dramatically and is still down. It's down a little bit for Silicon Valley, but not nearly as much as it's down for the other first two counties. And in Central Coast and cities, it's both down slightly, probably about the same order of magnitude as Silicon Valley. So 3 of the 5 regions have a shortage of inventory, roughly the same, where Central Valley and North Bay have a huge shortage of inventory. Offers accepted. Silicon Valley, even though the Silicon Valley, Central Valley, and North Bay have roughly the same number of volume of offers traditionally, Currently, Silicon Valley is leading the pack with the most, and it's getting pretty close to its normal. It's still got a shortage of offers, which we saw earlier in the presentation, but the shortage of offers is even greater in the North Bay and Central Valley. Cities and Central Coast has a shortage, but Central Coast is getting pretty darn close to where they typically are. So in order of shortage, it's probably Central Coast has the least shortage, followed by cities, and then probably Silicon Valley, and then Central Valley and North Bay. Days unsold inventory, this is the speed of the market or how long it would take to turn over the entire inventory more accurately. Silicon Valley has the lowest fastest paced market at 45 days. Yep, 45 days to sell everything out. North Bay, Central Valley, and the cities are dead even at basically 60 days. And the slow area is Central Coast at 85 days to sell out their inventory. It's very related, but a different metric is how long is it taking 75% of the sellers to sell? In Central Coast is the longest at 52 days. Then you have, it looks like North Bay at 48 days. Then you improve dramatically down to the Central Valley at about 37 days. Then the cities at 34 days. And the fastest is Silicon Valley at about 25 days for 3/4 of the sellers to sell their property. Here's the ask price reductions. Silicon Valley has the least amount of price reductions at 1%, followed by the Central Valley at 1.4%. Then you have a tie for North Bay and the cities basically at 2% price reductions, and the largest price reductions in the Central Coast at about 2.7% of a price reductions. This is the frequency of the price reductions. Got a three-way tie with North Bay, Central Valley, and the Central Coast at somewhere around 32% of the sellers taking price reductions, just shy of a third. Then you have the cities at just shy of 20%, and with the least amount of price reductions is Silicon Valley at somewhere around just over 16% of the sellers doing a price reduction. Here is the average overbidding. So the area that's doing the most overbidding is the cities at something like 6.5% overbid. And then you have Silicon Valley at something just shy of 6%, call it 5.8% maybe. Then you jump all the way down to the North Bay at something like 0.3% overbid. Central Valley is just a sliver under exactly getting their asking price. And the Central Coast is about 0.5% below the seller's ask price. Frequency of overbidding. Silicon Valley has the most overbidding at something like 66%, followed by the cities at 57%, then down to the North Bay at 44%, Central Valley at 40%, and the least amount of overbidding is Central Coast at something like 35%. Just a little over 1/3 of the sellers are getting more than asking price. Here's the total appreciation. By far, the cities is doing the least well at only 36% appreciation, followed by the North Bay at 63% appreciation. Then you have a two-way tie for, believe it or not, Central Coast and Silicon Valley at about 84% appreciation. And the area with the most appreciation is Central Valley at 90% appreciation. The Greater Bay Area sold prices, Silicon Valley is the highest, but it's basically now tied for the city because the city improved dramatically. Then you have Central Coast being the next most expensive area, North Bay, and the most affordable area is the Central Valley at just over, call it about $570,000. Moving on to payments, assuming an 80% loan, Central Valley is the most affordable at $4,000 a month, followed by the North Bay at $5,500, then the Central Coast at about $8,100. And then you basically got a tie between the cities and Silicon Valley at about $11,500 a month payments using the 30-year fix. Here is your different counties down the side. I also added in Silicon Valley with the first region we talked about, and also the Bay Area. And I think the Bay Area is really a garbage number. The only reason I include it is because the media talks about it so much. Then you have your metric going across the top of the graph. You can look at whatever number is most important for whatever it is you're trying to do. And with that, we are wrapping up and not seeing any questions. Have a great week. Take care. Bye. Thanks for joining.